Welcome everyone to our latest webinar in our Capital Insights series, the last one for 2023. Thank you so much for joining us today. This series is meant to provide information and have a discussion on topics related to funding your innovation startup in order to help entrepreneurs as they scale their businesses. Today's session will focus on funding essentials. I'm Petra Stegman, the Senior Director at Connect, where I lead our Springboard program. Connect is a nonprofit organization created some 30 years ago. Since then, we continue to work with life science and high-tech entrepreneurs to help them grow and scale their companies through the various programs we offer. We have an exceptional panel lined up for today, so let's get started. It gives me great pleasure now to introduce today's moderator, Matt Browne. Matt is a partner in the corporate department at Cooley here in San Diego. Matt has been with Cooley San Diego for 24 years and spends a lot of his time working with emerging tech and life sciences companies on their formations, their financings, IPOs, exits, and other important corporate events. Matt is generally the first point of contact for all things Cooley for his clients. Matt grew up on the East Coast, and fun fact, he's a Mets and Jets fan. Welcome, Matt.
All right. Thank you, Petra. Happy to be here. Welcome, everyone. Really delighted to be the moderator. We have a great panel today. I'm going to let each of the panelists introduce themselves. The three panelists are Oriana Bretschker of Aquacycle, Ashok Kamal of NuFund, and Nuth Morris of Ankona. Oriana, do you want to kick us off and maybe give a little 1 or 2 minute background about yourself?
Yeah. Great to see you all. I'm not able to turn my camera on. There we go. Perfect. So my name is Oriana Bretschker. I'm the CEO and founder at Aquacycle. We are now headquartered up in Escondido. We are homegrown since 2008 San Diego, and we provide wastewater treatment services for industrial clients. We work with corporations like PepsiCo, Diageo, Niagara Bottling, etc. And we provide treatment as a service, helping them meet their compliance and sustainability goals.
Cool. Ashok, you want to jump in next?
Certainly. Good afternoon, everybody. Thanks, Petra and Matt and all our friends at Connect and fellow panelists. Good to see you all again. I think I know and have worked with everybody here. As Matt said, my name's Ashok. I'm Executive Director and Fund Manager for NuFund, which used to be called Tech Coast Angels San Diego. We're an angel group and fund investing $10, $11, $12 million a year into venture startups, including ones like Aquacycle, which is one of the 100+ portfolio companies that I've seen get funded in my now 7+ years here at NuFund and in San Diego. Like Matt, I'm also from the East Coast, but a Red Sox fan. I did live in Queens for 15 years, so I respect the Mets, and I'm not the biggest Red Sox fan anymore based on some of the moves they've been making. But I moved to San Diego after spending the prior 15 or so years in mostly New York City, back and forth, working on my own startups and businesses, and started angel investing myself when I moved here. And that's what I focus on full time now.
Awesome. Thank you. And yeah, I didn't know we had that connection. We'll have to talk about that offline. Nuth, do you want to give us a little background on yourself?
Yeah, hi, Nuth Morris with Ankona Capital. I'm from the East Coast as well, actually from Maryland, I guess, which would make me an Oriole fan. Not a Ravens fan because we didn't have a football team when I grew up, but we got one later on. But so my background, Ankona is a what we call early growth fund VC firm, early growth stage. We invest in businesses that are $5 to $15 million in revenue, between $5 and $20 million checks. That translates to late A or Series B, predominantly focused on digital, so SaaS. Prior to Ankona, I was an entrepreneur. So I started a company called Telligis, which was early on in GPS tracking, fleet logistics, etc. So myself had been through bootstrapping, paying for things on credit cards, raising angel money, eventually raised a pretty significant Series A from Kleiner Perkins and exited the business to Verizon. So I've been on both sides of the table in these conversations.
Awesome. Cool. All right. Well, let's jump right in. Ashok, I'll start with you. You're an angel investor, like you said. Oftentimes, you're the first uh, institutional money, quasi-institutional money in a startup. Can you give us a high-level overview of what you look for in a term sheet, like when you're creating a term sheet, working with a potential company you'll invest in?
Sure. So stepping back a little bit, since angel investor isn't really a monolith, and the different flavors of angel investor also can affect, for example, a term sheet and the features that an investor is looking for in a deal. I'll just say that when people use the term angel investor versus, say, venture capitalist, and a lot of people do both, by the way, even simultaneously. I'm sure Nuth, has done his fair share of both. But angel investors are investing their own money. So, money that is their personal funds that often they don't need to clear, get approvals, or administer through someone else. Again, there are nuances to this, but since it's somebody's own money, they could have different reasons for investing. Now, I would say there's really three types of angel investors. So you have relational angel investors that may be investing in a person based on a background with that person or based on characteristics that they like within that person. Then you have financial angel investors who are really looking for a certain return and are doing this as a business as much as anything else. And then you're going to have strategic angel investors who may have some other reason for investing in a company based on an industry that they're interested in, for example. And some people overlap, but depending on the type of angel investor, I think that's the first thing you want to segment if you're out there raising money is what type of angel investor are you talking to, because that will help you formulate your positioning of the company for the investment. Generally speaking, very high level, we're looking for, in my case, let's say companies that can grow pretty big and scale with some sort of a 10x plus exit opportunity. And that's because since angel investors are investing earlier in companies than many other type of investors, more of those companies are going to fail. That's just the reality. It's as high as 50 to 75% out of every 10 companies aren't going to make it to that exit. So the ones that do need to pay you off for the ones that didn't make it. And the way that you're able to construct that type of a portfolio is by swinging big when you take swings. Of course, the other characteristics that any investor looks for in a company is a strong team with a market that has an opportunity, some kind of a competitive moat that they can protect their intellectual property or whatever sort of the edge for that company is. But broadly speaking, I think most investors are looking for a big opportunity with a quality team that has good timing in an interesting market.
Cool. Awesome. News, how about from your perspective? Anything like what's sort of different? What's the same?
Yeah, so I think when it gets up to our band, as Ashok mentioned, I have done some other stuff. So I've made, hey, this sounds great. Let's throw a little bit of money at that, kind of an angel investment. But when something gets to us, it's $5 to $10 million in revenue. So at that point, the equity is priced for sure. Some of the other ones you're looking at a safe note structure or something, which is more of a discount to a later round. Where we are, things become priced. So valuation definitely comes into focus, and I know we have more to discuss on valuation later on. But that is relevant in that, is there upside in this? Can we make money? One thing I would say apart from that is the alignment of what the upside potential is. And by that, I mean, it's not only how is this priced now, but what has to happen in the business down the line. Are we required with inflection type growth, where this needs to be a unicorn type outcome, multi-billion-dollar plus, or are we aligned with management in that we need to, let's not take an early win off the table, and that's reflected in valuation structure and some other things. The other thing, given it is priced and that there's typically been investors before us, we're selling money, which is by definition the most fungible thing that's out there. So we have we need to make sure that our offering is compelling to all parties. Founders are certainly important, pre-existing investors, et cetera. And so that we need to take into account the financings that have happened before, and how all parties see upside in it, just not besides us. The other thing that will factor in when we come in are protections. Given the fact that our checks tend to be a little bit bigger, we'll want to understand what our downside risk is, and so there's a couple different structures that can come into that, at a minimum of liquidation preference, etc. And the final thing is governance. Are we represented properly on the board? Do we have the ability to have our influence felt when we feel it's appropriate? And bound up in all of this, I would say, is that the term sheet, the way that we view it, is it's at the end of a process in terms of building a relationship with the company and all the stakeholders and gaining alignment around the vision that as to how we see the company and the success path play out.
That's really, no, that's super helpful, both your perspective and Ashok's. Oriana, from your perspective, being sort of the person who has been raising money lately, I know you've raised a 10 million venture round. When you get a term sheet, what do you look for? And just generally your relationships with someone who might invest in your company, what are you thinking about when you meet someone who might want to be an investor in your company? What are you thinking about, from there through the term sheet stage?
Yeah, relationship is I think the key word there, because as both Ashok and Nuth mentioned, right, it's you're evaluating a team, you're evaluating a long-term relationship in some cases, right? And everybody's got to be committed to providing value and aligning on that value and how we get there. And so, over the course of 7 years, AquaCycle in total has raised about 20 million. So we're just through the B round stage right now. And we started with NuFund, at the angel stage, looked to more corporate venture for our A round. And then we've done some bridges in between, and that has been, reinvestment from our existing cap table in addition to those that have led other rounds, and then bringing in, more corporate family funds, impact groups. So we have a good span of diversity in terms of the types of investors on our cap table, which means we have a pretty big cap table over the course of 7 years. And I think one of the key things is ensuring that we're communicating effectively, especially on rounds and what the terms are and how things will change. Communicating regularly as to progress in the company and where we're taking it, and ideally, ultimately, to an exit, which is profitable for everybody.
That's really insightful. It's something where I think it's like one thing I find interesting with you having such a large cap table is how does it work if you're bringing in kind of a strategic or an impact investor? Is that something when you were negotiating the earlier rounds, you were thinking, geez, I might be bringing them in. I have to work with people I can trust will be willing to let me bring in some money, even if it may not be absolutely required, but I think it's going to have a big impact on my business. Like, was that in your head at all?
It was. Well, we kind of had an interesting path to CVC investment. So we had largely been angel supported, and this was through safes and convertible notes. And so, by the time we got to our price round, they had actually found us, and this is Vopak Ventures. They're a European tank terminal operator, headquartered out of Rotterdam, and so they were seeking growth in their portfolio of investments that would complement their operations and their ultimate goals in the energy transition space. And so this was kind of an interesting opportunity that presented itself that we hadn't necessarily considered. But that opened up doors for our B round co-lead, which was Ecolab, which is directly, in line with our space. And everybody kind of taking a different angle. So those two corporates having a different angle. One corporate investing in us to help them improve on their operational capacity and sustainability in that. And then the second corporate that invested is much more we can complement their existing business, and commercially we can help each other grow. So it's two different relationships. One was opportunistic, which was fantastic alignment that we didn't anticipate, and the second was very much strategic in on both ends of the coin of like, okay, this is a really good fit, and this is how we can both capitalize on the investment commercially.
Cool. That's really cool. So Ashok and Nuth, let's talk about valuations. We were just talking about it. This is always a little bit of a mystery to me on the legal side. How do founders arrive at a valuation? Like, how do you all work with founders to arrive at a valuation? And maybe Ashok, maybe we'll just go same order. Start with you if you don't mind.
Yeah, well, the good thing is with a Nuth and a firm like Ankona that's a little bit more growth stage, they have metrics and they're focusing on, say, B2B SaaS companies. They've got a blueprint for the type of companies that they're looking for, and there are a lot of market references to be able to price that type of a company. So it's maybe more tangible and a little more science at the venture stage, particularly the later and later stage the venture gets. At the angel stage, there may not be really clear benchmarks for valuing a company, particularly if the company is doing something very novel. So your comps, for example, other known financing events from companies that you could consider substitutes might be one way that you would value a company that you're looking at. Another would just be based on ownership benchmarks. So typically in a seed round, for example, let's call it $1 million or $1.5 million, a founder or the founding team might sell about 20% of the company, or sell the rights to 20% of the company if we're talking about convertible notes and safe. So there's sort of an ownership benchmark that you can look at. And then for some companies, you may have tangible data points like monthly recurring revenue, even at the angel stage, that you're able to use as a multiple to then arrive at some kind of a valuation target. But the thing I'll say is, at the end of the day, particularly the earlier the company, valuation is a function of supply and demand of money in the market. So the value of the company is the value that investors at the threshold you're seeking are willing to pay you for those rights or ownership in the company. It's a supply and demand equation, and it's never going to be perfect.
So how about maybe talk about one of your investments that was like a super challenging valuation exercise, if there's one that comes to mind.
I'd say the hardest ones to value are the ones that are the most frontier in their technology and market. Even a company like Aquacycle that has a very novel clean tech solution in a hard to sell into market that Oriana and her team have been able to, through willpower and product and just good management, crack to the point of getting strategic corporate ventures interested. But that's a massive leap and chasm to cross. So if you see a company, we'll just say Iridia, for example, to pick a San Diego example, that's using synthetic DNA for big data storage, and they're in the lab and they're years away from commercialization in a best case scenario, how do you value that company today? It's not easy to do. There is no direct comp in the market. So it ends up reverting to the kind of ownership benchmarks, which both apply to the company and that they really don't want to sell, say, 75% of the company in its first financing, but also the investor or the fund that has often ownership targets for the investments that they make, where they want to own, say, a minimum of 3% or 5% or 1% of a company. So that's where there can be some math applied to the formula, but it's not easy.
Yeah, no, it sounds like really challenging to me, actually. I'm always kind of amazed when I see frontier companies come together with investors and determine valuation, it's always like, it seems like a very creative process. So I'm always very impressed by it. Nuth, what's your perspective? Like, what are things you're thinking about when you're thinking about valuation?
Yeah, so as Ashok referenced, we're a little bit probably more range bound than the earlier stage folks, given the fact, I mean, we look at two things really quickly, which are public company comps, some discount to that, and then precedent transactions or recent transactions. There are some other things we can, including the competitive dynamics and so are we the softer things? Do we have skill sets that might bring something to the company that's appealing to the company? But all that translates to a fairly well understood range of values. The caution and the thing I would say to an entrepreneur, particularly a newer entrepreneur looking at this, be most skeptical of the highest valuation. That's because there's more to it than just valuation. And there's more to it than the valuation on this round. Particularly if you're on a path where whatever you do right now, you have to carry forward into the next round or into an exit. So be very conscious of just the highest headline number. In many cases, it might not be the best deal for you. Value, and I think right now in this environment where valuations have been coming down, many companies did things in 21, 22, which seemed great at the time. Huge headline valuation, huge paper net worth for all the management team. But now as valuations have come back down, they're in a difficult position to raise on financings. So if they'd taken a more, had not chased the highest valuation, done something a bit more grounded, they can be in a position now where everything is up, everybody's very happy, and the business has created value for everybody. And even if the company is exactly the same in terms of revenue growth and cash burn, if they're coming into a down round environment, everybody's very sad. So it's not just this round that matters, it's what happens from here on out. So along those lines, and this is a part and parcel of valuation, is really understand the implications to the waterfall. And usually this is obviously the preference. So the new money that comes in is going to be at a minimum, the most senior money out, sometimes with a multiple. There could be other types of structures that sit on top of that, whether it's warrants or participation or various other things. You can have a huge headline number for common and whatever else, but you can end up in a lot of scenarios where major shareholders walk away with nothing if you're not careful with that. I encourage you to work with the folks at Cooley that can really walk you through the various scenarios and what the implications could be for all shareholders. As Oriana mentioned, this is a long-term relationship. So again, going back to my point of the headline number, make sure this is somebody you can get involved with and work with 5 to 7 years through thick and through thin, through upside scenarios and downside scenarios. The other thing that I would say that I've become more attuned to now that I understand that on this side of the table is do understand some of the fund dynamics, because as capital providers, we have customers too. There are people that are writing us checks, and so they're our customer. That's who we're providing services to, really. And that how old is the fund? How much of the fund is deployed? Can you get a sense of how earlier investments in the fund have performed? Because all that could translate to pressure to get to some kind of event that may or may not be on the company's time frame. Might be hard information to get, and it might be a little bit foreign for operating CEO being in the trenches, but it is kind of worth understanding some of those dynamics. Final thing I'll say, and this has been long enough now that I find myself having to point long enough ago. There's in the show Silicon Valley that came out probably 15 years ago. There's a whole episode on maximizing valuations, the implication of a down round or what have you. So it's worth digging that up on HBO or wherever it is to kind of see it in a very humorous view.
That's funny. Yeah, that was a great show. One of my partners was actually one of the like sort of creative consultants to it. So yeah, so a lot of people here enjoyed watching it and would kind of watch to see if anything was going on that sort of rang a bell around things that might have happened here.
To watch sometimes, like, ooh, we did that, So.
It's really true. Oriana, how about you from your perspective? How did you navigate the valuation process? It sounds like you've raised from a variety of different investors over time who have maybe, different objectives or like launch points in. How have you handled that? Or what are your lessons learned? However you want to answer it.
Well, we did everything wrong to begin with. We learned a lot. But no, fortunately, actually, we had some early investors, angels, actually LPs and NuFund, and local to San Diego that were very helpful in helping us define what what's fair on the first term sheet, right? And so we did that very collaboratively before they made the decision to invest. And so we ended up doing convertible note, setting a cap, at 5 million with an interest rate and a discount. And I think it's an 8% interest rate and 20% discount. And that enabled us to move forward and get our first 2 million that had been committed. But we weren't quite ready yet for a price round. And so in order for us to, on paper, elevate the value of the business, we elevated the cap on the term sheet for the convertible note. And this also kind of brought in a little bit more FOMO, if you will, right? So from the entrepreneur's perspective, right, we want our investors to be excited about what we're doing and make quicker decisions. And so we capped the timeline on each extension on the cap of the convertible note. And we did that. We raised up to 4 million, and we terminated that finished that note at 7 million of the cap. Then we're ready, right, for a price round, and all of that converted. But the negotiation on our first price round, which was with our corporate venture, was very pragmatic. We were able to increase the value of the company and really put a price per share out there. And it was I think we landed on 18 million, which was not bad from where we were. But we've been very, to Newt's point, also more conservative in terms of where we're setting our valuation. And that's also a little bit inherent to the business that we are. We're a capital intensive, big hardware business, right? We're not going to scale as fast as SaaS. We can certainly be a $1 billion company, but it's not going to happen in 2 years. And so where we have to be realistic in setting our value is okay, what does that growth rate look like? When are we going to hit our revenue targets realistically? And negotiate very, very practically, with the next leads, and ensure that we're vision aligned on time and total value. So we've increased, and we've done pretty good, but we've raised smaller pieces of money more frequently, specifically so that we're not taking in a huge bubble at a really high valuation. So we're not getting rid of, we're not selling 40% of the company on the next go around, and trying to avoid those down rounds, because it has been a very strange few years with very high highs and now getting into some low lows.
So that's really interesting. So you and Nuth are kind of, saying similar things, talking about being judicious, maybe about setting value and thinking about, sort of the next round and the round after that, and sort of what the impact is on their business, or on your business, and what it can be. So we'll talk about the market in a bit, but because I think the market kind of plays into all that. But just, and Nuth, you kind of talked about this somewhat too, but like, Oriana, are there any particular things that you've learned over time in terms of the actual provisions in the term sheet, aside from sort of value, and sort of ownership percentage and things like that, that you would say, geez, founders, that would be one I'd focus on, like protective provisions or anything like that are more maybe from the legal side? Does anything ever bit you after the fact that you didn't quite appreciate?
We've been fortunate to get good advice in terms of, what, especially, outside of the valuation. So what terms, if we go into this and we agree to these specific terms, warrants or kind of non-standard provisions, what the impact is going to be for us in raising money next, And we actually, negotiating the lead on this last round, we had a higher valuation mark. And so to make everybody comfortable, they negotiated back with a couple kind of weird terms, which would have been difficult for us to get past in the next round. So we decided to lower the valuation and take out those terms specifically so we could set up better success going forward. I think from a founder perspective, right, each time you're taking in new money, you're diluting. And one of the things that I guess I would recommend, and what was recommended to me by some of our investors and other founders, is that negotiate a top up on your ownership so you can maintain a certain percentage. And that's been important to our existing investors as well. It's been ensuring that we're not completely diluted out and still motivated to move the company forward. And so that's been a negotiating process to maintain founder ownership over the last 2 price rounds.
Neat. That's really interesting, just in terms of that's interesting. You made a conscious decision to take the lower valuation, but get rid of some of the sort of off-market terms. Nuth and Ashok, anything that you particularly focus, because I know you kind of went through a number of things. Are there anything in your particular list of the different things in a term sheet that you focus on that, if you had to rank them from sort of the legal end, not the valuation or the ownership percentage, that are particularly important to either of you as investors?
So broadly on a term sheet, the book Venture Deals talks about economics and control being, the 2 categories of nuances, and protective provisions, for example, or, is one that, founders and everyone needs to consider, that's different from valuation, which is, what people tend to fixate about. But I'll just say one of the rights that we look for in an agreement with an investor, with a company, is information rights. So information rights are basically updates on the company and its progress, and they can come in many different forms, including quarterly reports that a founder will send to its investors, which is a good practice for a lot of different reasons. But information rights are one, even at, or maybe more so at the early stage, we look for in our investments.
Interesting. And they don't, the companies that you invest in don't just blow you off and not send you the information when they're supposed to, even though the contract says they're supposed to send you something quarterly or whatever. I always wonder if people actually send that information out.
Sometimes we're late.
Yeah, it runs a spectrum. I mean, so Oriana is one of is a mindful, and communicative CEO. Not everybody has that level of sophistication or sense of responsibility. Some people do blow it off. Some people blow it off from jump. Some people change their cadence of communication, which is usually a very bad sign, by the way, when you're getting monthly reports and then suddenly it goes dark. It's hard to enforce the information rights. As an investor, the worst thing that you can probably do is somehow close the company down. But that's in nobody's best interest, regardless of the scenario. So I think just setting the expectation up front through formal information rights or another type of less formal agreement, that it helps you and the investors to stay on the same page. I think it's just a good expectation to set up front, and information rights are a way to codify that.
And I didn't mean to sort of discount them by saying blow off. The ones I was thinking of is often it'll say like audited financials by a certain date, and sometimes getting the actual audit done takes quite a while. And I know that a lot of the companies I work with miss those dates. But in terms of getting like the monthly reports out and things like that, I think people tend to be pretty good.
Yeah, even a basic, accounting of what's working, what's not working, and how you can be helpful as an investor is a welcomed, format for an update on a monthly or quarterly type basis.
Yeah, no, that's good. Nuth, how about on your end?
Yeah, the only thing I would add to what's been said is that just keep in mind that your shareholders are one of your customers too. They're one of your constituents. You sold them a security. And I think the past couple of years have actually demonstrated why you need to have good relations there, because there's your performance and then there's the markets, and crazy things can happen in the markets, and the people that you need to turn to first will be your existing shareholders. So it's really incumbent to keep them happy. Other things in terms of, information rights and various governance items where we invest, we kind of, for the most part, take a board seat, but not always, in some cases, an observer seat. That's one. The various financial and security items that are in there. Oriana mentioned there's concepts like warrants and things like that that can help solve for a valuation mix match or something, as long as various protective provisions such as drag along rights and tag along rights. The other thing that we look at is where the option pool stands. And sometimes we might require the company to issue more options, whether to incentivize the management team, depending on the financing history before the option pool, the management team might be diluted. So it's important to us that they're incentivized and aligned with us. At the highest level, I think there are a couple resources to look at. There is the National Venture Capital Association. They have form agreements that give you a good sense of what's in market and out of market. And I think most importantly, what took me quite a while to realize in my professional career is that you'll negotiate a transaction once every couple of years at best, and when you go to sell the company, that might happen once in your lifetime. Great lawyers are not only they keep you out of court, they're some of the best business consultants you'll have, because they're doing this in and out. And so your attorney can look at this and say, this is in market, out of market, or I've seen it solved this way, that way. So great attorneys are great business consultants, and really rely on them in terms of figuring out what you should be doing.
Well, thanks. All I can say is thank you
Matt,
very
not pay
much
me to
for
say
that.
that.
Thank you for that plug. Yes, I appreciate that.
It's way cheaper to pay your lawyer up front than on the back end. They're way more expensive back then.
Yes. No, I mean, I think, because like you're saying, that just the repetitive nature of someone who's like an attorney or a banker, if you're doing a sale of your company, they just see a lot of different things happen, whereas you just may have less reps because you're running a company. You're actually outgrowing, operating, running a company, right? Versus the lawyer's job is what they're doing in terms of operating a company is just working on those kinds of transactions all the time. So, yeah, the lawyers can definitely be helpful working through term sheet issues. So let's go and talk about the market and sort of overall conditions and what that should be. Like how should founders factor that into their expectations when they're doing fundraising and thinking about term sheets? Should they be planning on a longer fundraising cycle, for example? Ashok, why don't we start with you? Like, what would a typical fundraising, like, what would you tell a founder, like, as a fundraising cycle? Like, if I'm a founder, I want to raise money, let's say angel money, and let's make it, sort of more the, financial angel money you talked about earlier. Like, how much time should I think that's going to take? How long should I think that's going to take?
So to the fundamental question of whether a founder should be cognizant or sort of responsive to market conditions, the answer is absolutely yes. Again, I previously suggested that raising money and valuation is a supply and demand equation, which is based on a marketplace. So if the marketplace dynamics have changed, then certainly it's going to affect the dynamics of your fundraising effort. How exactly? Well, one is, Matt, what you just pointed out, the duration for a typical raise. A seed raise maybe was even 1 to 3 months a couple of years ago, and now I'd say it's more like 3 to 6 months. So, roughly speaking, maybe it takes twice as long. I think Oriana spoke wisely in some examples of, the way she even configured a recent round, which was, during this, let's say, downturn, in considering the price cap and how it represented the company in today's market, looking at some of the other more detailed provisions that could be considered, friendly to investors, and not being too fixated on maybe a price target she had 2 or 2.5 years ago, even though the company made considerable progress, the valuations in companies overall have gone down by, say, 20-30%. So you have to be flexible, I think, as a founder. And the ones who I see get themselves into the most trouble today are the founders who are pegged to what their valuation might have been if they've raised, multiple rounds 2 years ago, or the ones who are pegged to what they hoped their valuations would be today 2 years ago. In other words, they just haven't adjusted to the reality of the market. And that's one of the fastest ways to pass on a company if you're an investor. You might like everything else about the company, but at the wrong price, it doesn't pencil out. And you can just move on to one of many other companies that you also like that has a price that is just more appropriate.
Got it. No, that's really helpful. Keith, how about in your world?
So it's definitely longer than it was a couple years ago. But what I would say is that it's closer to the historical trend line of normal than a couple years ago was. In that that was a unique period of time that we probably will not be coming back, that we're back to kind of the old normal. So I think one thing to keep in mind is in terms of Ashok talked about valuation expectations a couple years ago. In the SaaS world, historically, 5 to 8 to 9 times was the exit value of companies, sometimes as low as 3. So that's we're likely to be the environment that we'll be exiting in for a very good exit, a strong exit. That's for us as a firm. That's what we were underwriting to even in 21. That was a likely exit window. So I think it's really important to understand that and that there's the multiple side and the total valuation side. Most great exits happen in the $100 to $400 million range. That's a knock it out of the park exit. It really is. It's easy to see on, the headline, so-and-so gives a deck of corn after 2 years of working. That is, you hear about it a lot because it's so far of a long tail outlier. So with that in mind, if that's the exit window, think about what that means for your business in terms of how much you need to raise right now, what you need to put out. Because if you overraise, bring in too much cash, and even if you're able to push up the valuation, that might take really compelling opportunities off the table. An investor like us at our stage, we require almost that we see a 3 to 5 times our money upside. So if you raise at $100 million, that means you're kind of locked into a $400 to $500 million exit. And it might not be, and the business might not warrant that. The market there might be some issues or things like that, the pilot, but it might be a great $150 million exit, which is still plenty life-changing. So I think it's really important to understand these scenarios, and in particular, not to take a base hit or a double off the board unnecessarily and lock yourself into a grand slam. So with that in mind, on all of these, I would really understand in terms of pricing the total size of the deal and the amount that you need to raise. What are you going to accomplish with the business, really? And it's not just get bigger. Like if we can get to X revenue dollar and we've got these economics in our business in terms of how we're growing and how we're retaining, like I encourage you to get really focused on what you're going to do to make sure you're executing on it. And that way you can prove to yourself and to the next set of investors or the acquirer that you've unlocked this value and that the business it warrants a higher valuation.
That's great. Brianna, what are your thoughts? I mean, like you're obviously operating, running a business, and then at the same time, you're having to kind of keep in mind these considerations about like financial markets where you may be raising. How do you approach that? It's a little bit of a juggling act.
Yeah, I mean, as a founder, we're always raising, right? It's either
Yeah.
like need the check in the bank right now, or I'm gonna need it in 6 to 8 months or 2 years from now. And so it's about developing those relationships and cultivating a knowledge base around what we do and how we're scaling and where we anticipate going, so that future races hopefully get a little bit easier. But yeah, it's a challenge, right? And And I know that's true for our investors who have funds as well, right? They also have to raise money, and this year was particularly rough. I'm not gonna lie. You know, we've had some very strange things happen over the last 5 years, right? We had a once in a 100-year pandemic. We've seen the financial industry take some pretty big tumbles, and that you know, always creates uncertainty and perceived higher risk in investing in newer companies. And so it's important that, you know, every founder keeps an eye on that, and reacts appropriately, because we are always raising money. But yeah, it's, you know, I would say in terms of timeline and planning, yeah, if you're a company like ours, which is hardware, plan for a year at least, you
Okay.
know, to close it out. But if you can create more knowledge and get excitement built ahead of the next raise, then ultimately, right, the close can be faster. Finding a lead can be faster because they already know you, and so you're building that knowledge base. But it's, you know, fundraising is a challenge, and constantly learning how we can do it better. But it's part of the game. It's part of what it is.
How do you connect with funds or investors you might want to try to meet who you think might have an interest in your company? And I guess I'd love to hear from Nuth and Ashok on sort of ways it makes sense for ways companies find you or you find companies.
Yeah, so we ask our existing investor network, you know, who do you know, who would be interested? And then we ask for those introductions. And of course, you know, there's events you know, that are specific, often industry specific, but opportunities to connect with investors that might be outside of your core network. So for us, right, there's the clean tech event that happens in January every year. And so you've got climate tech and clean tech investors that are converging, you know, specifically to meet with new opportunities. And so it's a good way for us to get the word out. And then once, even if it's not a fit right now, you know, may be a good fit in the future. So creating a mailing list, you know, once that connection is made, keeping a regular cadence of communication. I'm not always the best at that, but, you know, aiming at, you know, a few times a year just to give updates in terms of progress, where the company's at. And you know, highlights of, you know, this new you know, round is going to be opening soon, and get in while you can.
And Ashok, what do you think? I mean, I know your fund sees a lot of, you know, the way your fund works, I imagine you get a lot of business plans and proposals all the time. Are you doing any hunting outside of that, or is that mostly how you find your opportunities?
Yeah, I mean, we're hunting all the time. You know, you're in the business of finding those, you know, stellar companies, and you have to put a lot of irons in the fire as an investor, having, you know, open applications in our case on our website, taking introductions from everybody from portfolio CEOs like Oriana to co-investor partners like Nuth to service providers in the community, being present at events. So we'll have people blanketing in locally events like Startup San Diego and all the university clusters for entrepreneurship, and even, you know, in our case, expanded nationally of that principle. I think as an entrepreneur, you want to take a buckshot approach into the ways you're reaching out to investors, but be very disciplined in the type of investors that you reach out to. So, you know, for example, Oriana mentioned a event series or incubator, Clean Tech San Diego or Clean Tech Open. That's appropriate for her, but she doesn't need to waste her time being in a, you know, blockchain meetup. So I think that's the key, is to put a lot of irons in the fire on both sides as an investor or as an entrepreneur, but focus those irons in the platforms that are appropriate for your type of fund or your type of company. And then you never know whether it's going to be the event or that cold email, you know, or that referral that ultimately sticks you with the person that you want to talk to.
Awesome. What do you think, Nuth?
For us, we spend because where we sit in the capital stack. I think it's one point. Keep in mind that a lot of investors are very stage dependent. If they're not, they're either stage dependent or vertical dependent. So a lot of vertical funds will go up and down regardless of stage. Most of us are stage dependent. So whether or not it's Angel, Series A, Series B. So that's something to anticipate. You'll need to move up the stages with investors. So for us, given where we sit at Series B, we spend a lot of time with earlier stage funds, understanding about their portfolio and what the potential breakout companies are. Keep a couple other things in terms of how funds like us operate internally. We have limited pools of capital, and we have partners and LPs. And so the communications that Ariana alluded to allows us to, to kind of get excited about you early, even before you're in market. Now, understand there's a balance of what with your day job, et cetera. But keeping it full in mind kind of allows us to allocate capital, even if it's not officially, that, hey, there's going to be this great company coming to market. I want to make sure we got some dry powder for it. The other thing to keep in mind is that we have to work for the business. So folks like us will do our best to be helpful where we can, even if we're not investors at this point. So Aquacycle needs a great chief scientist. I happen to be out in the network and someone approaches me like, hey, I know this company out in San Diego. You should really check them out. And that's a way for us to keep on top of the stack, so to speak, with the great entrepreneurs and the great companies that are coming down the pike.
Cool. Awesome. All right. Well, we got about 10 minutes left. We got a few questions here. Let's see. One of the questions is, are rounds priced at a discount to what a future round might be expected to be? Or is that something that's beneficial to the investor, the company, or is that mutually beneficial?
Yeah, I read the question. I think it also had my name on it, so I can start.
All right.
There are many types of deal structures, and we alluded to here priced equity, safes, convertible notes. Convertible notes and safes may have discounts attached to them. So a convertible note or a safe is basically a right to convert into equity at a time in the future. The main reason for using safes or convertible notes is just the simplicity of the administration. That's one. And the other is it's hard to price the company at present. So you're punting the valuation of the company to a future date. And the uncertainty of that pricing then justifies some kind of a discount typically. So are they good for founders or for investors? They can be good for both if it helps you arrive at a deal that you both otherwise feel is fair. And that's why most of the earlier stage type investments, including most angel investments, tend to be in safes or convertible notes. All else being equal, in my view, a priced round is better for the investor and arguably better for the company for a variety of tax and governance, kind of in and other, sort of reasons that set a clarity on, the cap table, but it's just not always practical. So one of the questions there was whether future financing events are discounted if investment is made today. In the case of a convertible note, they typically are, and that's to help compensate for some of that risk around what the price may be in the future.
Yeah, and for the second part of this question, I believe I'm reading off the same one, is how do we view this structure? For the most part, we don't. That's for us is a very clean way to get in. So if the note was a $10 million note with a 20% discount, that's very clear. And if we come up with a $15 million valuation, the note converts, everybody converts to equity, and everybody's happy. So that's a very clean way to go in it. Now, if it's below the cap price, then that's when you get people that are less happy. But we usually don't see a lot of those in the market because the previous investors would have done their best to kind of clean that up before it goes to the broader market.
That makes sense. I think that's it on the Q&A because I think we kind of answered the other question that's up here. I think those are all the questions. So just sort of wrapping up, any thoughts from the panelists, things we may not have covered today that you think would be really helpful for somebody who's, trying to raise money? early stage.
Well, I'll say one, having yourself prepared is in your favor when you're trying to raise money. And that goes all the way back to doing your research on who the right investors are and segmenting your list, through understanding the dynamics that those investors have in their current investing vehicles. For example, if they're at the end of a fund life cycle versus the beginning of a fund life cycle, and also having your ducks in a row with the materials that you're going to need to share with an investor for the investor to make a decision. That translates into a data room, for example, where all of your corporate docs and your business docs should be warehoused in a way that's shareable with the investor, should there be mutual interest in progressing into due diligence before making a final decision. So you can do a lot of things as a founder to make the process as efficient for you as possible, and that alone will put you in a better bucket in terms of the prospects that investors are dealing with, because you have to understand that investors are typically funding 1% or so of the deals that they're seeing. That's just the raw, hard VC math. So the more you can do to make that process user-friendly for investors, who hopefully are also making the process user-friendly for you by being transparent in their timing and the type of checks sizes that they'll write, that just sets the relationship off on the right foot. And even if ultimately a financing doesn't occur, well, maybe you go back to that same investor in the future when you hit some other milestones, or maybe that investor goes back to you when you're starting your next company. And it's the beginning of a relationship that could unfold in many different ways.
That's great advice. Oriana, you have anything you'd put out there that we didn't cover?
Well, I just add to what Ashok just said, right? A no to me is a not right now. And so, it's important to just to build that relationship and to be prepared. So, consistently updating the data room as progress in the company evolves, consistently updating your pitch, and practicing and seeking feedback, and making sure that you're also, that you're advocating for your company, your existing investors, and ultimately, right, you're looking for a partnership. And so not all money is smart money, and it's really important to also bring in investors that are aligned with how your company is going to grow, and be able to also support, beyond just writing the check, and participating on being an active board member, facilitating customer discovery and connections, helping you recruit and retain, just really their partner in this and helping the company grow. And so just founder's perspective, that's super important.
Oh, those are all great things to be thinking about from the founder's perspective. Nuth, you're gonna have the last word.
All right, so I'd only add two points on this. When you start getting into our stage, Series A, Series B, there's revenues. Get used to operating on a model that you update regularly. We see businesses that seem pretty good, but they've just been winging it, and then they come to raise money. It's like, well, okay, here's where the hockey stick and blue sky. It's like, well, how do you know this is the first time you put this down on paper? But the sooner you figure out how all the pieces to come together and how these become metrics that point to your success, and use that and update it every month, that'll just put you on a much better track to communicate with investors and demonstrate that to them the ability to execute, which is a big part of what we're looking for. The second thing I'll say about this environment being much more healthy, a couple of years ago, you could tell it was easier for entrepreneurs to sell shares in their company than it was to sell their product. And that was the overabundance of capital, that it was easier for them to come to market again and again and again. Whereas right now, making the capital markets a little bit constrained means that it's easier to go get money from your customers than from your shareholders. And that's probably a better balance. Because at the end of the day, remember, all these things have the cost of capital, which means that you're coming out of the equity that you have in the business when you raise money. Now, I may be talking against my book here, but the cheapest cost of capital you have will come from your customers. And there's also various ways to, whether it's payment terms and payments up front or whatever else, working with your vendors, there's ways to get cash into your company that are non-dilutive just by becoming a better operator. So don't remember that's a key part of this. And I think a more capital constrained environment will help sharpen the sword for all the companies that are out there.
Those are great points too. All right, I think we're at the end of our time. Petra, do you wrap this up, or do I wrap this up? Just want to say thanks everyone for attending. Thanks to our amazing panelists. Really appreciate everybody's time today. Thank you.
Great. Yeah, this has been
Pleasure.
fantastic. Thank you so much, Matt and Ashok, Nuth, Oriana. There's been some great insights and lots of good advice here for startups to keep in mind as they move forward. And I want to thank everybody who joined in today and listened in. I hope you found today's webinar insightful for the companies that you're building. As mentioned before, this webinar is recorded and will be made available to everyone. And we hope that you'll be able to join us next year as we roll out some new Capital Insight series. I wish all of you a wonderful day wherever you may be, and holidays are right around the corner. So happy holidays, everybody. Thanks so much.
Thank
All
you
right.
all too.
Thanks everybody. Bye.
Bye.
Thanks all. Take care.